G'day, and welcome to the Pumped on Property show. Now, I'm super excited about today's episode because, as you know, I'm a huge data geek, and it's just me, it's just Ben here with you today, talking about my thoughts or our thoughts as a business on the Australian property market in 2019. So, for all of you who like my data side or data oriented approach, there's going to be plenty of that today. Now, Ben Everingham doesn't have an opinion on what's going to happen in the next 12 months because unfortunately I'm not a fortune teller. I don't have a little crystal ball sitting here with me. I don't know what the fuck's going to happen, but what I am doing is taking information from the people that have a better idea, that have been doing this for 20, 30, 40 years, 50 years even, some of them, and really trying to bring you that information so that you can stay up to date. You can, if you do invest this year, invest safely and with confidence, or if you're sitting out of the market this year, you have a good idea of where you're at and what opportunities might be out there. My thoughts on the Australian property market on 2019, my personal thoughts, I'm going to leave to the end of this. What I'm going to start with is really a update from some of the key pieces of data or the key sources of data that I've done in preparation for this for you. So there's not my brother sitting next to me today. Crystal's not here with me. Adam's not here with me either to pull me up. If I go down a tangent or two, I'm sorry about that, but welcome to the Pumped on Property show. We do try and get real about this stuff, and this is exciting for me to the point where I've actually put together 5 or 6 pages of data to share with you guys based on some stuff. So Heron Todd White, as everybody knows or may not know, produces a really cool monthly report called the Month in Review Report. Now you can Google that for free, Heron Todd White Month in Review Report, and it has a really nice little property clock on one page basically explaining where each of the major metro and regional markets in Australia are at right now. It also gives you about 60 to 70 pages on the residential, rural and commercial property markets, about 60 pages each month as well if you're a data dude and you want to get into it as well. So these guys have been producing these reports for a while. I've been following them now for 4.5, 5 years, and they are very, very, very accurate based on what I've been observing, and they're pretty up to date as well in terms of, because it's a monthly report, they're actually got the finger on the ball. Now, like everyone, they don't always get it right, but if you look at trends over a 3-4 month period, maybe a 6 month period, you can pick it up. Now, the first thing that they said for the December report, they haven't released the January report yet, but nothing happens in a month in the property world, as you guys know, is that Sydney is now officially in the declining stage. So pretend you've got a clock in front of you, 12's the top, 6 is the bottom, 9 o'clock's the sweet spot, which is the rising phase, and 3 o'clock is really the shit part of the phase, which is the declining phase. So Sydney's in the declining phase, Perth is in the declining phase, Melbourne's in the declining phase. Now, for everyone over there in Perth that's listening to this, it's no surprise. Unfortunately, you guys have been in this phase for 5 long years now, but you had a fucking amazing run for the 5 years before that. So when you make 100% in 5 years, sometimes the 5-year period after that isn't great. Brisbane, in terms of the metro markets in Australia first, is at the rising market phase, which is why I really like the Southeast Queensland market. In terms of the major regional markets, you guys know that I'm a quality over quantity investor. I like to buy really, really high quality assets. My scope of confidence is really around Sydney, Melbourne and Brisbane. They're the markets I focus on personally and will continue to put my money because historically they've performed very, very well, and I like to go where the population, job and infrastructure growth flows. But for those of you who don't mind regional markets, there's only a few regional markets in Australia that represent long-term value to me personally. I know there's other places that do good over a 10 or a 20-year period, but I'm looking at this stuff as everything I'm buying today I'm going to have for the next 30 to 50 years and hopefully pass it on to my kids. So I don't want them to be in a marketplace that goes up in value over 10 years and then ends up being a piece of shit because it always actually was one. So the regional markets, Sunny Coast is approaching the peak. The Gold Coast is starting to decline. It's had a very, very strong 5-year period of growth. Wollongong is in the declining phase, same as Sydney. Newcastle's in the starting to decline phase, and Ballarat is in the rising market phase. I couldn't find information on Bendigo in the December report. So, they're the big marketplaces. Personally, I don't really want exposure to anywhere outside of probably Sunny Coast, Gold Coast, Wollongong, Newcastle, on top of Sydney, Melbourne, Brisbane in my personal portfolio. But that's why being a human's awesome, because everybody gets a chance to do their own thing. And if we all had the same idea, then 1 or 2 markets would be crazy expensive and no one would think about the others. So that's the exciting thing about being an investor. You get to create a strategy based on your risk profile and choose your own adventure, which is fun. So that's sort of the Heron Todd White update in terms of where the markets are at. Now we look at CoreLogic. Now, CoreLogic is Australia's most reputable, most trusted, and most data-orientated, source of information, I believe. One great thing about Australia that a lot of other countries don't have is we do have this centralised Australian Bureau of Statistics and CoreLogic that feed off each other. And therefore, we've got some of the most accurate, probably the most accurate property data in the entire world. So this data coming out of CoreLogic, I effectively track every land sale, every house sale, every unit, townhouse sale in Australia. And they've been doing that now for almost 20 years, which is just freaking awesome. Especially if you're into your history like I am. Now, they just talked about big picture stuff. They talked about a lot of stuff. So I'm going to go through some of that. They talked about some negative stuff. They talked about some positive stuff. They talked about reasons why this is going on and why Sydney's been declining for the last 18 months, for example. So, basically, this was a wrap-up on 2018 from them and looking into 2019. In 2018, property values Australia-wide declined by about 4.2%. But if you actually break Australia down into a series of markets, it was really Sydney, Melbourne, Perth, and Darwin that drove a lot of that price reductions. In their update, they talked about 5 or 6 of the other metro markets actually increasing in value. Regional Victoria, Regional New South Wales still recorded gains. So, Sydney and Melbourne were the worst hit. And why so many people are talking about Sydney and Melbourne is that 55% of Australia's asset value in terms of the value of commercial residential properties in Australia is in Sydney and Melbourne. And so when people say that Australia is in a housing bubble, a huge amount of that so-called bubble is a result of putting all of Australia into the same box as 2 cities which have 55% of Australia's asset value. So when Sydney has gone through 100% growth or 70% growth over a 6-year period of time, historically, same as Melbourne, same as anywhere else in Australia, it generally sits flat or it corrects for a period of time. And so Sydney has now declined since its peak by 9.5%. Now, if it declines by 9.69%, it's going to be the largest decline since 1988 to 1990. So we're going into a territory where we're now potentially looking at the largest declines in prices in Sydney, or the largest correction in almost 30 years. And that scares people. Like, that is why there's fear in the media. That is why there's fear in the TV. That's why there's a lot of investors sitting there doing nothing. Because if I own $1 million property or a $5 million property, the last thing I want is for that property's value to have gone down by at 10% 100k, or at $5 million I've lost 500 grand now. So, this is why people are scared. This is why people are confronted. If you know your history, if you know where we are in the overall real estate cycle, which I'll talk about more later in this podcast, then you know that this is just the normal path. But so many people have a recency bias, and so they don't look at what's actually been happening over the last 200 years. They just look at what's happened in the last year and they go, property declines in value, so I'm going to sit on the sidelines. And people like me are aware of that. We're cautious when that's happening, and we also take advantage of that when it's happening too. Melbourne, on the other hand, has declined 5.8% since its top. whereas Hobart, Adelaide and Brisbane have all increased in value over the last 12 months. So again, you've got to start to see Australia as a series of markets. Of course, what happens on Today Tonight or the Today Show, or if Sydney and Melbourne are declining in value, it's going to have a flow-on effect throughout the rest of Australia. But you've really got to start understanding, particularly between 2019 and 2021, that Australia is a series of markets. And the worst case scenario, even if Sydney and Melbourne lost 20 or 30% of their value, other marketplaces in Australia are in a much, much better position to take advantage of that. Again, I don't believe it's going to be anywhere near that, and I'll explain some data to support that soon. Now, let's talk about the reasons these markets are declining. Outside of they went off their fucking heads for 6 years, and you've got to take that into the equation, things can't go up by 10 or 15% every year indefinitely, or we will have a bubble. But the major reason for this time around, and it's different to other times around, because generally when property prices are declining according to core logic, they are declining as a result of interest rates rising and therefore making it more unaffordable or harder for people to buy property and continue to hold property. But the major reason that's happened this time is it's man-made, it's us. Our government and the Reserve Bank of Australia has decided enough's enough. Enough speculation in Sydney and Melbourne. It's becoming very, very hot down there, and that could create a huge problem for us in a few years' time if it continues. We're going to put the brakes on credit policy and therefore the availability of finance. And particularly we're going to look at the investment marketplace. So the self-managed super funds, the international investors that were coming into Australia and buying it up and driving prices up, as well as the investors in the marketplace, which at some points over the last couple of years represented up to 60 or 70% of the properties being bought in Sydney and Melbourne. So it's a natural thing when you say to a big percentage of a market that we're going to make it really fucking hard for you to get money, that it's going to have a knock-on effect down the line. Now, tightening of finance has been the major reason that RP data have sort of said that this has happened, or core logic. But there's a number of other reasons why Sydney and Melbourne are coming off. One reason that they gave, or Tim Lawless gave from Core Logic, was that rental yields are on the decline and they're almost historically low down there. Like, do you really want to go out there and buy a $1 or $2 million property and get fucking $500 a week rent from it? Like, that is dangerous. That is stupid, especially if you're not going to get that capital growth. So the fact that yields are low has also had an impact. The migration rates into Sydney and Melbourne in particular have declined over the last 12 months, and that's a result of it just being so unaffordable to rent or to own down there. The media sentiment and consumer sentiment has obviously slid as property prices decline over time. That tends to happen. He also says that buyers have an advantage over sellers in the current marketplace, meaning that, a couple of years ago in Sydney and Melbourne, as you all know, or whoever was buying it at that time, know that auction clearance rates were very high, days on market were very, very low, average discounts were almost zero, and people were overpaying a lot of money, a lot more money than they should have paid for those properties at that time. And you can look back at any of the videos I've recorded in the last 4.5 years talking about and forecasting what was going to happen, because you don't have to be a rocket scientist to see this stuff. If you understand your history, you understand cycles and timing, and you consistently keep in contact with the marketplace and the right people like HTW, like Core Logic, and a few of these others I'll talk about. Now, we've also got an environment according to Core Logic, and this is another reason why things have softened a bit or gone backwards in Sydney and Melbourne, is that mortgage rates have increased a little bit. Even though the rate set by the Reserve Bank of Australia is extremely low right now, there's still about a 2.5 to 3, maybe even 4% difference between where they're setting the rate and what most lenders, like the big banks, are actually giving people money at. So the rate might be 1.75%, but your home loan might be 3.5 through to 6%, depending on which lender you're with in your financial capacity. So, there's higher mortgage rates, which obviously have an effect. What you've got to remember is that we've still got the lowest mortgage rates we've had since 1960. And so while it might feel expensive to you right now, it's because you've got a recency bias My parents have had rates of up to 18% in the past in the 80s. So just get some fucking perspective. When money's being lent to you at 3.5% to 5%, that is dirt cheap. Now, government changes are obviously another reason why some people are sitting on the sideline. A lot of people, from my experience, this is my third federal election that I've gone through being an investor, sit on the sidelines for the 6 months leading up to the election. A lot of businesses just sort of sit there and wait and see. And then what happens in the second half of the year after the election's gone through and everybody knows what's going to happen, people come flooding back into the market. Now, I like to buy when other people aren't. I don't like to buy when everybody else is doing it. So election years, January, December, public holidays, times when sentiment's low can all be great opportunities to buy property because people make decisions at those times of the year that they don't make at other times of the year. So understanding this stuff and looking at it from a real world perspective, not just talking shit about it, but actually based on the $300 million worth of property that we've bought for myself and my clients, you know, these little lessons constantly come out. Now, some of the positive things, because there's always a positive thing going on, when sentiment's like it is at the moment, you know, you've also got to remember that there's two sides to the coin. 2 or 3 years ago, only good shit was being jammed down all of our throats. Now it's only bad stuff, but at that time there were negative things setting up, and at this time there's positive things setting up. So Australia's gross domestic product, which is effectively how much money we spent and made last year, is up. It's actually higher than it has been on average, which is a positive thing. We're not breaking crazy records, but at least it's above average. We've got ridiculously low unemployment rates, almost the lowest unemployment rate since before the last recession. We've got great population growth. Some people are forecasting that that might start to slide a bit next year. It really just depends on foreign policy effectively and Australia's feeling or sentiment towards people coming into the country. That has a lot to do with housing affordability, obviously, and jobs. But the reality is almost everywhere in the world is facing chronic undersupply of people right now that they need for jobs. Like, there's some chronic undersupplies in America, Europe, you know, just really, really interesting stuff going on. In Australia, it's nice to see that it's below that 5% mark. Wages have actually started to increase a little bit again. You know, that's a positive thing too. So don't buy all the hype, don't buy mine. This is just core logics, but some positive stuff, some light at the end of the tunnel. Now, as you all know, I love Phil Anderson. Phil's a really, really, really interesting guy with a very, very different perspective on society and investing and cycles than a lot of other people have. He's an Australian economist who's been living in France and investing all over the world for a long time. He wrote a book called The Secret Life of Real Estate and Banking. I subscribe to his weekly newsletter, and it is honestly the highlight of my week. As an investor, it's like investment porn for me. I love the dude. You know, I really get a kick out of his approach to things. It just makes sense to me as a data guy. Now, Phil has been sending me emails. I think I've been subscribed to his newsletter for 3.5 years now. For 3.5 years, he's been talking about the current cycle, and each week, each month, telling me what's coming before it does. To this point, it's been completely accurate, which has been really nice. It's nice to have someone that can see a little bit of the future based on the history of the past. He calls it remembering the future. So you can't predict the future, but you can remember it based on a good analysis of the past. Now, for these 3.5 years, Phil's been talking about 2019, maybe 2020-21 being what they call the mid-cycle slowdown point. I'm not going to go into his 18-year cycle, but jump on my YouTube channel or jump on our blog on our website, www.pumpedonproperty.com, or just Pumped on Property on YouTube, and take a look at the 18-year real estate cycle video that I created. It's just, again, rehashing what Phil talks about, but effectively we go through this period after a recession or a depression where the first 7 years is generally very positive. There's a reason for that, because banks and governments all over the world what they call pump prime the economy with cheap, dirty, easy money to get things rolling again. And then we get to this point where it's like commodities, stocks, properties are fucking expensive again, and people go, well, all of that cheap money is now priced in the marketplace. I think we might just take a chill for a moment. Generally what happens at this point, at some point over the next 2 years, based on history, is the American Australian stock markets get wiped in a big way. Not just a little way, not like the little thing that we just saw in December, a 10%er. I'm talking about fucking smashed, like somewhere between 20 and 60%. Talk to your financial advisors about this and ask them what their plan is for this period of the cycle. If you've got big money in stocks or shares in your super fund, or if you've got big money in stocks and shares personally, just understand the history around this stuff. So Phil's been calling this mid-cycle slowdown point for the last 3.5 years. I'll talk about my thoughts on that and his thoughts on that and what you should do a little bit more. You've got to remember that right now the world isn't all in. So the difference between a mid-cycle slowdown point, which is where stocks, shares, some commodities, some property, some marketplaces are expensive right now, is, because it's been cheap money and it's been a period of just pump priming the economy to get things going again. But the difference between where we are in this cycle, according to Phil and Fred Harrison, again, not Ben Everingham, just their work, is not so much that things aren't expensive right now or that things aren't overcooked in the stock market, potentially parts of the property market around the world. But what generally happens is, because there's money sitting on the sidelines right now, I certainly have cash in the bank. I'm assuming you've got some cash in the bank. I'm assuming we've both got some equity across our properties. There's a lot of other people around the world sitting in that same position. Not everybody is all in right now. The banks have capacity to lend money. The governments, or particularly the Australian government's in a pretty healthy position when you compare it to other governments around the world in terms of debt. A lot of the big hedge funds have been taking money out for the last year and putting it in as cash. And because the earnings of a lot of the biggest companies in the world have had such a strong profitability for the last 2.5, 3 years, they're all sitting there with fucking huge amounts of cash. And that's the difference between the mid-cycle. There's still money around. When we get to the top of the cycle, which is like a GFC, or like the recession we had to have, or like the Great Depression, everybody's all in. The governments are in debt to the bullshit. Individuals are completely maxed out. They're all in because they can't remember the last time it was really bad. All of the big businesses are completely all in. Even the big businesses are now buying property and stocks because it's so profitable for them to do so. All of the big banks lending the money are all in as well. They've gone completely unresponsible. They want to make record profits again, and they've all got greedy. And all of the dudes from 18, 20 years ago that learnt the lesson the hard way are now gone because people don't exist in the banking space for 20 years. And so that knowledge is gone. And that's the point where you've got to be really scared. In the mid-cycle slowdown point, historically, property prices around the world can drop between nothing and 15-20% in the over-leveraged markets like a Sydney and Melbourne or a New York or a London. At other times, nothing much happens. Generally, or almost always for the last 100 years, the stock market has been smashed by it. So at the top of the cycle, it's not just the stock market that gets smashed, it's businesses, people lose their jobs, and the property market gets absolutely hammered as well, or it should do. So they're things to take into account and to understand. Phil's thoughts for the next couple of years in 2019 are keep some cash to the side and get excited because there's going to be some incredible buying opportunities. And like I have said before, I believe the mid-cycle slowdown, if you're a smart investor, really represents only one of two buying opportunities every 20 years. So you really want to be buying at the bottom of a global recession, your stocks and your properties if you can, and you really want to be looking at buying at the bottom of the mid-cycle slowdown after things have corrected, because they're the only times over a 20-year period where we get really, really big discounts. Now, most people do what everyone else does, and that's sit on the sideline during these periods. They get scared. But as the next person I wanted to talk about says, effectively buy when there's blood on the streets. You didn't want to buy Sydney 20% more expensive 2 years ago than it is right now for the right property. And if you had have known your history or you'd been reading the right stuff, you would have known that too. So Ray Dalio, he founded Brightwater Associates. It's the largest and most successful hedge fund in the world. Now, I've been listening to a lot of his stuff at the moment. He is fucking amazing. If you haven't read his book, Principles, I highly recommend it. One of his videos where he's talking about 2019 as a year for investment and 2020 is that he believes, particularly American stocks, some commodities and some properties around the world have been fully priced in. Now, what he means by fully priced in, based on my understanding, is that all of this cheap money's come into the economy over the last 7 years since the last GFC, or even 10 years. And all of that easy money, easy credit has flowed into artificially inflating the value of certain stocks and certain properties around the world. And so, he doesn't have a crystal ball. I don't have a crystal ball. Obviously, I'm just a punter from Australia. I don't know this stuff. I haven't been in the industry for 50 years, 40 years like these guys that I'm talking about have. But I do follow them religiously. And, it's really important to understand that certain assets are fully priced in right now. And when they're priced in with cheap money, it means once that cheap money goes, there can be a wash-through effect there where the prices of certain assets can come back. Now, Ray's got a different approach to the cycle than Phil Anderson and Fred Harrison do. His approach to the cycle is it's about a 7 to 8 year cycle, which sort of fits actually really well. It's just 2 cycles instead of 1. You can look at his stuff. He's a conservative investor for 2019. From his approach, he's sort of waiting to see what happens in the stock markets, the share markets. He's got cash sitting on the side. He believes the time to buy is when there's blood on the streets, as opposed to when prices of certain asset classes are extremely high. Now, one thing that he said, which was super interesting, that I checked out, was a recent Bloomberg article, and the title of the article was "American Mum and Dad Investors All In, Successful Hedge Fund Managers Sitting on the Sidelines." Now, that's an indicator that we're close to the top. Phil Anderson also has other indicators that he looks at. So does Ray, like the yield curve. Now, the yield curve is quite simple. It's really the 10-year yield curve that's most important, but the 3 to 5 year curve inverted very recently. An inversion of the yield curve in the 10-year yield curve historically has pointed towards a coming recession in America. The yield curve is very simple. It's effectively what price is the Federal Reserve of America giving money out to the banks today. So as you know, the Fed Reserve Bank of America has been increasing their cash rate for the last year and plans to increase it by 2 or 3 times again this year. When cash is really cheap to get and the Reserve Bank's giving it out really cheaply, then the banks can give out cheap money, and it obviously flows through the economy that way. As the price of money increases to the banks and what they can borrow, then they have to pass on those rates to consumers, which means more expensive home loans, more expensive business loans, more expensive money if you want to invest it into stocks or shares. So what the yield curve is comparing that 1 year cash rate, which in America right now is now over 2%. It should be up at 2.5% probably by the end of this year, maybe even higher, against the 10-year bond rate, which is the rate that the government or American government creates bonds. Now, in Australia, it's a little bit different, but it's a similar sort of thing. And, what you've got to look for is this inversion point where the 10-year bond rate actually touches the 1 year cash rate or actually goes beneath it. So the 1 year cash rate's higher than the 10-year bond rate. And for whatever reason, over the last 60 years, almost every time that's inverted in America, the American market's gone into a recession. Now, a recession sounds scary, but a recession is just 2 consecutive quarters of negative growth in the economy. So a recession's not a big deal, although the media will make it feel like one. Generally, what happens during those times, when we go into recession, is unemployment rates rise, the cost of money can increase temporarily for a period of time, and people can, overall confidence-wise, not enjoy their time as much. We can have a small reduction or a large reduction in property prices, stock share values, etc. So it's just important to know that stuff. One thing I loved about Ray's latest videos is, you've just got to learn to understand the cycle and timing and then take advantage of that. He believes the only way for the average person to invest is with a long-term approach, which I 100% agree with. It's all about investing for the long term. It's all about taking advantage of buying conditions as they come up, taking advantage of selling conditions as they come up, but having a long-term approach, which, as Warren Buffett describes, I just finished watching his new documentary, the HBO one, on YouTube for free. It's fucking amazing. Completely goes into his approach, but Warren calls it value investing with a long-term perspective, which effectively means buying great assets at reasonable prices and then understanding that it's a 10, 15, 30-year approach to getting to where you want to be. Now, I know that might not sit well with some people because everyone wants it today, but the sooner you can delay your short-term gratification, the sooner you can achieve what it is that you really want. And I'm so grateful, but between the ages of 24 and 33, I've been able to create financial independence in my life. So now I can spend the next 60, 70 years of my life helping you get in a better position and obviously continuing to set up my own position as well, which I don't really give a fuck about the money, but what I do care about is the choices I now have in my life. I no longer work Fridays. The last 2 months of last year, I only worked 3 days. Just got back from a 3-week holiday with the family. I really, really, really have this desire to show people that it's not about the Lambos and the Ferraris and the beautiful homes and all the bullshit. Although it might be. That's okay down the line when someone else is paying for it, like Robert Kiyosaki says. For me, it's about being present this year. It's about being in the moment. It's about contributing. It's about helping people. It's about enabling you to connect the dots this year about where you are and where you want to be and how you're going to get there and creating a plan. It's about slowing down to speed up and realizing that it's not a sprint and I don't have to live with the anxiety that I've had in the past, which is just pressure I've put on myself from having such big goals and such big dreams at such a young age. So I'm excited about that. Now, the next piece of data that I really liked was from KPMG. KPMG is one of the biggest financial consultancy companies and business consultancy firms in Australia and in the world. Now, what I like about KPMG is they made me feel good yesterday when I read their report for the next 3 years, which looked fucking awesome. Now, a lot of people are sitting there going, oh my God, how far is Sydney and Melbourne going to decline? I've been saying for years now that I think from top to bottom, Sydney will be somewhere between a 15 and 20% decline, and Melbourne will be somewhere between a 5 and a 10% decline. KPMG, who know a lot more than I do, have said that they believe this year 2019, will be another year of decline for Sydney and for Melbourne. They believe in the range of somewhere between 4 and 5% is how much further they'll continue to come back, which, if you put your historical hat on, is the worst decline that we've had in those markets in 30 years. So that does scare people, and if you've got money and you're thinking about it from a short-term perspective year to year, then that's scary. But I can guarantee in 20 years' time, almost whatever you own down there is still going to double in value, and you'll look back at this as just one of those years where you wasted a lot of emotional energy sitting on the sidelines or thinking about what your property's doing as opposed to taking advantage of buying conditions. The cool thing about KPMG's report was that they said by 2021, Sydney and Melbourne will be continuing to move through their cycle. Now, what I love about this is this completely correlates with what CoreLogic's been saying for years, what Heron Todd White's been saying, what Ray Dalio's been saying, what Warren Buffett's been saying, what Phil Anderson, Fred Harrison have been saying, what I've been saying as a result of listening to those guys for so many years is mid-cycle slowdown point, then we move on. And that's all it is. And you got to remember that, protect yourself. And now I'm going to talk about my thoughts about the next 12 months and what I'm personally doing as an investor, because as you guys know, I don't like risk. I hate debt. I have a very long-term approach to investing. I have a very low-risk approach to investing personally from my perspective. I have a concept in my mind that I only want the highest quality assets. I'm extremely selective. I'm extremely data-orientated and process-orientated. So these are my thoughts. I know I'm not everyone's cup of tea. I know some of you guys like Cowboys, and that's cool. There's no Cowboys anymore, unfortunately, and there's no Indians either. So, I'm just playing the long game. I'm playing the Ray Dalio game, the Phil Anderson game, the Warren Buffett game, the Robert Kiyosaki game, which is starting to create quality passive income streams with good capital growth for life, and slowly over time building that, knowing that the compound effect of the activities I take today will mean that in 10, 15, 20 years time, I'll never have to think about anything again, and I don't want my children or my grandchildren to think about stuff. And I'm not the Lambo Ferrari dude. I'm not chasing it for that stuff, the material stuff. I'm a pretty simplistic, I would say minimalistic guy. I drive a pretty conservative car, live in a nice home on the sunny coast, and that's about as far as it goes. For me, I just, know the effect of the activities that I'm doing now, and if they just compound and I do nothing more, everything's going to be epic for me, for my kids, and for my grandkids. So that's the thing, if you just allow time to do its thing, the average return in an index fund over the last 10 years, the average index fund, or 92% of index funds in the last 10 years in America, trading the S&P 500, did an average of 8.5% a year. Now, that's through the second worst or third worst recession we've had in the last 100 years. Now, 8.5% is an amazing result for an average punter that doesn't even have to think about their money. If you can then overlay selling at the tops, buying at the bottoms, timing the cycle, man, there's so much potential with this stuff, and same with property. So my thoughts is I'm going to continue to be conservative this year like I have been for the last 2 years. I'm just watching things. I will be buying assets again this year. I also may sell one of my assets this year. The assets that I'll be accumulating will all be in southeast Queensland, probably all of them in Brisbane, very close to the CBD or walking distance to the beach. I'll only be looking to accumulate assets this year that give me a dual income and an amazing cash flow stream, and I'll be looking to hold those assets for the long term and seeing how they perform over the second half of this cycle that we're going to go through. At about 2024, 2025 is when I'll be seriously considering where Brisbane's at based on its growth cycle that it's about to go through, and making a decision to either hold them or exit those assets at that time. Now, I always have a cash buffer in place. I'll continue to do that, and I'll continue to reduce my debt this year. In fact, for the last year and a half, 2 years, I've been increasing my cash buffer to take advantage of this 2-year buying opportunity that we're going into now. I've also been reducing my debts in a big way. Last year, or the last 2 years, I sold 4 properties to wipe off a huge amount of debt and put myself in a better position and replace them with better assets. I've been really, really actively, and I'll continue to do so, reducing the costs in my life and my business. I've recently been able to reduce the costs in my business by about 60%, which is insane. I've also been able to reduce the costs in my life by about 40-50% as well. So that's just been an approach where one thing at a time, big rocks first. I looked at my interest rates first. I looked at loans outstanding second. I then went all the way down to the micro, like what software programs am I paying for in my business? Where's the business at from a staffing perspective? Where's the business at from an overheads perspective? Just all of those little things, and I've been able to save huge amounts of money there, which has been fantastic. I think it's a year for you to consolidate and do some savings in your life. Have a good look at your budget in your business or in your life and look at ways that you can actively reduce it. I then went and dramatically reduced my interest rates. I was able to save myself over 30 grand this year in interest alone, or last year, sorry, just by talking to the banks and my broker and getting better rates. My thoughts this year is the negative sentiment is going to continue. As Sydney and Melbourne continue to decline in value, more and more people are going to get on the negative bandwagon and start, having an opinion, which is cool. Like, it's always nice when broke people have an opinion about money. I definitely listen to them. Let the broke people continue to have their opinions, and I'll just keep getting on with my life and my world. As Warren Buffett says in his doco, does it matter what anyone else has to say about what you do? And for him, he knows what his circle of competence is, and he just stays inside that. I'm going to take advantage of this negative sentiment, and I'm going to take advantage of the share market when it drops in value at some point in the next 2 years as well. I'm going to continue to focus on quality assets for myself. I'll stay out of the stock market until it, gets hammered, and then I'll be in there. But from a property perspective, I will be accumulating quality assets this year with a long-term perspective. Now, the big thing that has changed for me since I was 24 and just getting started, I bought my first 2 properties that year, and now 11 properties later for myself, 500 properties later for our clients, is I used to be very transactional, very short-term focused, very, oh my God, what's happening this month, this quarter, this year with my assets? Now I just don't give a fuck because I have a completely different perspective. I'm really not concerned if my asset drops in value by 20% in 1 year and goes up in value by 20% another year. All I'm looking for is quality long-term performance on the assets that I buy today. So I'm going to be continuing to have that long-term view. Realistically for me, it's all just about average buy price, and like Warren Buffett says, value investing, which means buying great assets at reasonable prices rather than buying shit assets at cheap prices. And that is something that's taken me so long to learn, but I'm so excited that I've learnt that now. I'm going to continue to focus on cash flow because it's king and it is so important for the next couple of years. And one thing I've just done is reviewed my cash flow in my business, reviewed my cash flow in my personal life, and reviewed the interest and principal I'm paying off the properties that I still have debt on, because I wanted to know exactly where my break-even points are moving into the next 2 years so that I can scale up or scale down as required. And I actually sat down and worked out a plan A, B, and C based on a really good market, a moderate market, and a really shitty marketplace for me personally as an investor. We have an election coming this year. Who gives a shit about it? To me personally, it means nothing. There's no historical correlation between government getting in and property prices. If you know your history, you would understand this stuff. There is historical relationships between wars and property prices and wars and stock prices, but when it comes to governments, I couldn't care less if it's Labor or Liberal personally. I'd prefer a Liberal to stay in if possible, just because they seem to be working towards a budget deficit, and I want us, a budget surplus, and I want us to be in surplus so that they can crank all of that money and get us into a huge amount of debt again in the next half of the cycle. So there's lots of jobs for people and lots of spruiking and lots of bolstering asset prices after they decline a little, so that they can pump things back up like they always do. And for anyone that's not across that stuff, this is government. Like, this is what they do. If you want to learn about this stuff, read Fred Harrison's book, The Power and the Land, or Phil's book, The Secret Life of Real Estate and Banking. There's a lot of people that have this perspective. Henry George's book. There's a whole problem at the moment with government, and the cool thing about the current government is they just keep facilitating the same system. Neither government's going to solve housing affordability with their current approach. Neither government's going to solve banking issues. Neither government's going to solve international trade issues. Neither government's going to really do anything. So you may as well take into perspective, you may as well take your own life into your own hands. And I know that there's a bigger picture. I know that things happen. I know that luck's got something to do with where people end up, or environment, or conditioning, or the way that we grow up, or the people that we surround ourselves with. And I know there's things outside of our control, and not everybody's lucky, from that perspective. But I know a lot of people that weren't lucky, that just work fucking hard and work smart, and that take personal responsibility for their lives and accountability for their lives, and just get on with the business of consistently investing in high quality jobs, businesses, assets, shares, property, whatever that is, and take advantage of conditions as they come up. That's the next one. The election's neither here nor there for me. If Labor gets in and scraps negative gearing, it could have an effect on short-term property prices. It might mean that a lot of shitty investment properties come onto the marketplace and there's not buyers for those shitty properties, which means the marketplace on those shitty properties, like the one-bedroom units that everyone seems to be purchasing in Sydney and Melbourne and Brisbane over the last 5 years, come back onto the market. It might mean that, less of the crappy stock in, way out in the regional areas or way outside of the cities that has been built on really small lots with brand new homes. Once the depreciation isn't available for those properties, all of a sudden the cash flow looks bad and they're not getting growth. There might be a flood of those types of properties come back onto the market. But honestly, if your approach to investing is negative gearing, stop listening to this fucking podcast and go listen to everyone else's, because that is the furthest thing from my mind when I'm thinking about investing. Why the fuck would you spend $1 to save 30 cents or 50 cents depending on your tax rate? It's here's $1, give me 50 cents of it back and I'll be happy with that. It's just a crazy approach. My priorities or my rules are timing first, capital growth second, cash flow third, the ability to add value fourth. Depreciation is about the 700th thing that I think about when I talk about buying a property. It is the last thing that I have ever thought about for a client. When clients come to me saying, I want depreciation, I'm like, no, what you actually want is to be financially free, and you want a high quality asset that grows in value over the next 10 to 15 years. Depreciation is what your accountant or financial advisor or some spruiker has told you is important. So, negative gearing is neither here nor there, but it may have a short-term effect on things. It'll be interesting to see if Labor does get in, if the conversation even starts, because this conversation was brought up 2 years ago when everyone was complaining about affordability. Now everybody's just hoping that their property prices in Sydney and Melbourne don't go to zero, and so it would be pretty unpopular to bring in negative gearing and drop property prices in Sydney and Melbourne by another 10% as a result, and have all of those voters get back on the Liberal bandwagon because you took away 10% of their $1 million of paper value. Now, Ray Dalio talks about that a lot. I like his approach to that. So I'll take advantage of the conditions as they come up. Now, my thoughts on rates this year is that they should be going up, but they're not going to. I think they're going to come down maybe once, maybe even twice next year. I've been sort of saying that they're going to come down now in 2019 for about 2 years in video, or sit flat. I was on Sky News recently about 6 months ago, and they were talking about rate increases, and I was saying, openly, you can check it out on the Facey page, it's not going to happen. They're actually going to go down, and the hosts were giving me a bit of a bashing about it, and I was like, they're going down because Australia isn't in a stronger position from an economy perspective as America is right now. American businesses are making bank right now. Australian businesses aren't doing as strongly, especially with this sentiment. So, rates could come down. You can see this. My variable rates are sitting at between 3.88% and 4.5% right now. I can actually fix those rates for between 3.5 and 3.8% right now. So the fact that rates for the next 2 years can be fixed at a lower point than the variable is today means that the banks are starting to hedge their bets about what might be coming. Who knows? I don't have a crystal ball. I just follow what the Reserve Bank of Australia is saying and what other commentators are thinking. Now, one thing to be aware of, Phil Anderson has been sort of saying this to me for 3.5 years, is in 2019, maybe 2020, there is a chance that America could go into a recession. Now, that's one of the reasons is business has been good. One of the reasons is a lot of things are overvalued there right now because of that cheap money. Another reason is the yield curve could invert. Another reason is this is just what happens after a recession after about 7-8 years. But what I don't think anyone took into account was an American president who's a businessman and a property guy and has a huge ego and probably doesn't want to be a president that takes America into a recession. So there could be some cooking of the books, but watch that space. I think if at some point this year, maybe next year, worst case the year after, America could go into a technical recession. I don't think it'll last long. It could be 2, maybe 4 quarters, worst case, before they do something about it. But, just keep an eye on that space. If that does happen, that will have a flow-on effect to the Australian economy. But like I've been saying all the way through this podcast, it is mid-cycle slowdown time. So you've just got to navigate your way through this time safely. It really affects stocks and shares a lot more than it affects property historically based on Fred's work and Phil's work. But, just be aware of that stuff. My final thought that I wanted to leave you with is just be safe. For some people, the next couple of years will be hard. For some people like myself, I hope it's one of the best buying opportunities of my lifetime to date. I missed the last, GFC, recession, depression, whatever you want to call it, because I was still studying at uni and I didn't have any money and I didn't even know that there was this cycle. This time around, I've set myself up over the last 7 years to absolutely take advantage of the next 2 years. I don't want to be buying when everyone else is buying, which is, why I sold all of my properties in Sydney and New South Wales in 2017 at the top of the cycle there, and have put that money in cash or into assets into other markets that can do very well over the next 7 years, which is really what I'm working on now, which will take us to the next top before the next major correction. Now, everyone's got different thoughts on this. This isn't really mine, but smart dudes, like when you hear Warren Buffett, Ray Dalio, Phil Anderson, Fred Harrison, CoreLogic, BIS Stratnell, HTW, Michael Matusik, all saying the same stuff based on 30 years of experience in the industries, then you sort of start seeing patterns. And I've just been noticing patterns. So stay safe this year. Build yourself a cash buffer. Reduce some debt. Buy really high quality assets. Remember that Sydney and Melbourne are fucking cooked and they're going to sit flat or decline in value for a while. But Brisbane, during that 10-year period that Sydney and Melbourne went up by 100%, went up by 15 to 20, 25%. Now, some suburbs did even better than that. Some suburbs did nothing. But you've got to start breaking Australia into marketplaces as opposed to an overall. So right now, the overall effect of Sydney and Melbourne has been negative sentiment Australia-wide. But how long are people going to sit on the sidelines for? Like, do you think mums and dads will sit on the sideline for 3 to 4 years and not do anything with their money when they're getting 1.5% in their bank and the stock market shits itself and crypto market shat itself last year? I like Brisbane because in the last 46 years worth of data, according to Homely, it's actually performed better year on year than Sydney and Melbourne. And because I'm looking at a 50-year investment strategy, that suits perfectly with my risk profile. CoreLogic predicts Brisbane to be Australia's top performing market between 2018 and 22. BIS Stratnell also predict Brisbane to be Australia's top performing market between 2018 and 2021. There's going to be 5 million people in Brisbane, which means it will be the same size as Sydney and Melbourne within the next 30 years, according to the ABS. And the growth rates into southeast Queensland now, in terms of internal migration, are the strongest out of any marketplace in Australia. We're getting more Australians moving to Brisbane, southeast Queensland than we are into Sydney and Melbourne. And we're going to catch a huge percentage of those people over the next few years as well. 75% of the jobs, according to Michael Matusik, and incomes are going to be created in southeast Queensland, Sydney and Melbourne over the next 10 years. 75% of Australia's jobs, population growth and infrastructure is going to come from 3 marketplaces. So this is why I'm bullish on those markets over the long term, bearish on Sydney and Melbourne over the short term. I also love that it's been flat or relatively flat for the last 10 years. So investing isn't for everyone, I get it. Investing when other people aren't investing isn't for most people because they get scared and follow the crowd. You know, I welcome you to come to Brisbane in 4 or 5 years' time when you're paying a little bit more for the asset value than you will today or in the next couple of years. Completely get that. But my question always is, how many years of my life am I prepared to trade away from my children? Am I prepared to trade my time for money? Am I prepared to not live my life's purpose and work a shitty job without creating a solution to get out of it? Now, one solution is to do nothing and end up on the pension. That's cool. Another solution is try and save yourself your way there, but by the time you get your $1 million in the bank in 30 years, that $1 million is going to be worth about the same as 200K today, and you're at it again. Another way is to strategically invest your way out of it. Another way is to start businesses. Now, I'm a business guy and a property guy right now. Over the next 5 to 7 years, I'll also start getting a personal interest in stocks and trading, just because I have some friends that are very good at it, that do it full time, and I've seen how well they've done now over a 10-year period, which is long enough for me to trust that that is something that I would like to be a part of based on their experiences. So I wish you all the best. It's certainly not a year to be silly with money. It's certainly not a year to go on a crazy spending spree. It's not a year to have no buffer in the bank. But it is a great year to buy strategically well-timed investments, particularly in the southeast Queensland market, Brisbane, maybe North Brisbane, Sunny Coast. I'm excited about it, and I'll keep you posted as we go through the course of the year. Now, what I love about documenting my ideas is they're out there for you to see. You can go back and look at my videos since 2015, 16, 17, 18 and see me saying things and, see if they've come true or not. Sometimes they do, sometimes they don't. I honestly don't know what's going to happen in 19, but that's my wrap. That's my thoughts. I hope you've enjoyed it. Please give us a 5-star review if you haven't already given us a review on iTunes or Spotify. Please subscribe to our YouTube channel, and please like us on Facebook and Instagram. So we're starting to do a lot more content this year. I'm super excited about it. If there's any videos you'd like me to do, just hit us up on social and tell us, or drop us an email. If you are thinking about buying this year and you like the idea of a high quality, lower risk property with long-term potential for growth, and you like the idea of adding cash flow to that property to really increase your rent return, then drop over to our website, Pumped On Property, and book in a free strategy session with myself or my brother Simon. Love to talk about where you're at, where you're looking to go, and create a idea or share some ideas for where you could be in 15 years' time. So thank you so much. I wish you all the best and good luck.